Hey everybody, today we're going to talk about the Morningstar valuation model. In this presentation, we're going to get a little bit more into the nuts and bolts than we will when we launch the valuation modeling competition in March. Hopefully, you'll be able to use this as a helpful resource as you think about building your model, and you'll be able to reference the slides as you think about particular issues that you found a little bit more challenging. As an introduction to our Morningstar methodology, we're concerned with long-term investing in quality companies at an attractive margin of safety. That methodology is built around Warren Buffett style value investing. There are five key pillars to this. First, we invest in businesses, not in pieces of paper. Our methodology is bottom up, not top down. We strive to analyze businesses. We don't analyze markets. We don't analyze macroeconomic forecasts. And we're not traders. Second, the market provides a valuable service but won't do your homework. Every day, for all of the publicly traded companies, the market provides a price at which it's willing to buy a company, or at which price you're able to sell shares. In the long run, it's often right. But we do believe that short-term mispricing exists. For that reason, we strive to determine value apart from price. Third, value includes growth. Growth and value are joined at the hip. We're not just looking for low earnings multiples or low price to book multiples exclusively as a proxy for value. Fourth, we always invest with a margin of safety. The relationships between businesses, economies, and individuals are extremely complex. For that reason, we should maintain intellectual humility and realize that we might be wrong and insist upon adequate compensation for the risk that we assume. That's the key pillar behind our star rating methodology. If a company drops into 4 or 5 star territory, we believe that there's enough of a margin of safety between our intrinsic valuation and the market price that investors who invest in that company should earn excess returns. Fifth and finally, we believe that mimicking the herd invites regression to the mean. To earn excess returns requires thinking differently than other market participants. If we think exactly the same and we use exactly the same data and modeling technique as our street competitors, we're likely to earn exactly the same returns. So, what is our edge at Morningstar? The typical sources of competitive advantage are informational, analytical, and time horizon as you think about equity analysis. There's nothing that fundamentally prevents us from carving out an edge on the first two buckets, but the most identifiable difference between our methodology and that of our sell side competitors is patience. Our valuations are three-stage DCF models, and that means, particularly for Modi companies, a lot of our intrinsic value comes from our stage two and our stage three or terminal valuation. This reduces our dependence on quarter to quarter estimates, and it allows investors to seek out to screen for high quality companies that they can hold for a really long time. As you look back, you can see the batting average of our wide moat focus index and the lower frictional costs, the emphasis on high quality companies, the equal weighting, and the emphasis on high quality companies at an attractive price, particularly, have allowed us to generate excess risk adjusted returns. The financial models, like we'll be building in the modeling valuation training and project, provide a really useful tool to consider company valuations and to identify mispricing. In the short run, as we talked about earlier, pricing and value frequently diverge. Effective models allow us to estimate a company's fair intrinsic value, and we think about that as the future value of free cash flow. Why would that be? From the perspective of an investor, I'm predominantly concerned with the cash generation prospects of businesses in which I'm investing, and whether or not I'm going to see that over time in the form of dividends, repurchases, or share liquidation. That's why we're concerned with cash flows. While we're willing to sacrifice current returns for a company like Amazon that's investing very heavily in the future, the trade off is that we ultimately want to see that materialize in the form of higher cash flow generation prospects, dominant market share, and ultimately some sort of cash flow receipt. Within the confines of our valuation methodology, the combination of pricing and fair value estimates can help us identify companies that offer an attractive margin of safety for investors. Importantly, it's critical to be accurate, not precise. Models should be decision useful. False precision is increasingly an issue with more advanced statistical methods and data mining. Our models should be decision useful and more right than not. And if we're able to get that right, we should do pretty well. As you can see on the right, looking at the returns of our wide moat focus index, excess returns come from a number of different screens. 70 basis points of annual return come from focusing on the highest quality companies. 160 basis points come from equally weighting those instead of weighting them by market cap. And 120 basis points of those come from buying those companies at a time when they trade below our intrinsic valuation at an attractive margin of safety. So, how do moats play into the calculus? Economic moats allow companies to derive excess returns for an extended period of time. Markets are competitive. Without any barriers to entry, any peer could simply raise capital and undercut the incumbent's prices, quickly driving returns down to the cost of capital. Economic moats are structural advantages that prevent this from happening, and our methodology is predominantly concerned with discerning how long those competitive advantages will last. As you think about why this might matter, if I were to take a dollar and go start a lemonade business today, I'd probably earn a cost of capital in the ballpark of 9%, the long term average for US stocks. But if I went and created a lemonade stand today and got a note from the alderman that banned anyone else from selling lemonade in the city of Chicago, there's every possibility that I'd be able to generate excess returns by charging higher prices, given that I didn't exist in a perfectly competitive market. That's effectively what we're looking for with moats, is companies that have some sort of advantage that creates some sort of barrier to entry, and that ultimately manifests itself in higher free cash flow and in higher valuations. Moats, like intangible assets, cost advantages, network effects, efficient scale, and switching costs, can protect a firm stream of cash flows and excess returns over time. We recognize five sources of economic moats at Morningstar: intangible assets, cost advantages, network effects, switching costs, and efficient scale. We have white papers that identify common sources and example companies that I'll refer you to if you want a more comprehensive treatment of the subject, but we'll briefly consider one example of each type of moat. For intangible assets, if I have access to a cornered resource, I'm able to benefit from lower costs or higher prices. The quintessential example here is patents in the pharmaceutical industry. If no one else is allowed to make the branded drug that I manufacture because I've got categorical exclusivity, I'm able to charge higher prices for that drug until the exclusivity expires and generic competitors are allowed to launch. That is one vehicle for excess returns, and patent exclusivity can last for as long as 20 years. In terms of cost advantage, if I'm the lowest cost producer, very few competitors are going to want to get an extended price war. Costco is a great example of this, with massive warehouses and selling groceries at a low single digit percentage margin. In fact, Costco earns most of its float by simply selling memberships to customers who care predominantly about saving cost on their groceries. And those customers, once they buy into the membership program, feel like they should use the membership, creating massive volume for Costco over a very limited number of stock keeping units. That purchasing volume affords Costco natural economies of scale that very few grocers can replicate. It also means that there's very little incentive for a neighborhood grocery store or even a Kroger or Albertsons to try to undercut Costco on price. Considering network effects, if all of the user traffic sits on my platform, there's very little incentive for sellers to go anywhere else. A good example in the United States is Amazon, where more than half of online product search starts. While I might be able to keep a greater proportion of the sales I generate on a smaller marketplace like an eBay, if most of the volume and most of the buyers and most of the eyeballs are on Amazon, I'd be pretty foolish not to try to sell my product there as well. Next, we'll consider switching costs. If my service touches critical business functions across multiple areas, then I'm going to be really reluctant to replace it. If stuff starts to break and I'm switching to a product that's just as good as the one that I'm using now or only slightly cheaper, creates a lot of risk for me with very little reward. A good example is ERP systems and technology. If I use the same ERP to manage my hiring and payroll and sales and customer relationship management, they can raise prices pretty substantially before I have the appetite to start sniffing around for an alternative. There are just too many risks tied to running two systems redundantly and retraining staff and switching away critical business functions to a new provider. Finally, in terms of efficient scale, there are certain industries that require a lot of upfront capital investment, and it's not necessarily efficient to have more than one or a couple of firms serve a market. UPS and FedEx in parcel delivery and freight forwarding are two very good examples here. So, how do moats impact valuation? We alluded to this a little bit with the stand example, but basically they allow companies to operate at a structurally lower cost than competitors or to charge structurally higher prices than competitors. What that means is they're able to generate a higher percentage return on the capital that they invest than it costs them to borrow capital. That sounds like a pretty good deal to me. For remote companies, the way that this materializes is beyond the explicit forecast years that we build into our model. They're able to continue generating excess returns for another 5, 10, or even 15 or more years for wide moat companies. The moatier the company, the larger slice of the pie ties to stage two valuation, in theory at least. You can see in the bottom right that for Chipotle, almost a third of the company's value ties to that stage two as their returns on invested capital start to fade towards their cost of capital. Our model uses free cash flow to the firm, which we'll talk about a little bit later in this presentation, for all companies but banks and insurers. For banks and insurers, we use free cash flow to equity, and we discount those cash flows at the cost of equity, largely due to the dynamics of loans being counted as liabilities but effectively being assets for banks. If we think that a firm has a moat, we believe that it's going to be able to continue to generate excess returns beyond our explicit forecast horizon. That's effectively what we price into our model, and that's why Modi companies generate so much value in that second stage of our three-stage discounted cash flow model. Typically, we forecast stage two to be a fade. So if my jump off point sees a company generate ROICs of 30% and my WACC is 9% for easy math, then that return on invested capital is likely to fade from 30% toward 9% over that stage two horizon as competitors enter the market. We don't necessarily add incremental value in stage three. We do not add incremental value in stage three from uh, returns on invested capital ahead of WACC, but we do have terminal value for a company. In effect, what we're saying is if we were to liquidate the company today, at the end of that horizon, what would it be worth? And we discount that back to present. In a three-stage DCF model, that stage three, that terminal value, can actually be quite high. But as an investor, that's what we're predominantly concerned about is cash flow through dividends, through share repurchases, and through the ultimate terminal value of the company. For Modi companies, that earning power tends to be quite a bit higher. More concretely, we walk here through the free cash flow to the firm calculation. You'll see this in the model, and I'd encourage you to take a little bit of time to understand it. But in a nutshell, free cash flow of the firm can be thought of as the cash that a company has left over after funding ongoing operations, working capital, and after making investments in maintenance and growth investment through CapEx. This is the number shareholders care about. Ultimately, a business is worth the discounted sum of its future cash flows, which we ultimately expect to receive, as we alluded to earlier, through dividends, share repurchases, or liquidation. If a company can generate a better return by investing those cash flows than we can by investing in the broader market, we prefer that it does so, at least for now.